we have Professor Dr. Vikram Chand, who has done a lot of research on this topic. He's going to make two presentations in two parts. He's first going to discuss Pillar 1 proposals, and then he's going to also talk about the Pillar 2 proposals. And I have requested him to also touch base on which is the Pillar 3 proposal. We are going to have a panel discussion wherein we will have representation from Italy. Professor Maestro is going to join us. Brazil. Professor Louis Edward Schonor is going to join us. From the UK, Jonathan Schwartz, Stephanie Johnston from the United States, Dr. Peter Bressler from Switzerland, and I'm very pleased to host this session. But very briefly, a little bit of background on what we intend covering in the session on what we feel are the tax challenges for digitization of the economy. Number one, we know the background on Pillar 1 proposals, which essentially deals with allocation of rights to market economies. We're going to discuss that, and in light of that, we are going to examine what is the current framework. And before we actually get to the current framework, we are also going to look into the historical perspectives, starting from the League of Nations debate. In the current framework, we will examine what are the current rules on legal nexus and profit allocation. As I was looking at the presentations, I just felt whether we actually needed a Pillar 1, Pillar 2 debate, or are the current rules on allocation of profits good enough? And I think Vikram has analyzed this very, very well. However, we also need to bear in mind that there is rise in unilateralism measures by various jurisdictions, not just about India. And this is what we call it potentially becoming into a trade war situation. This topic could not have been better timed than today, because we have seen day before yesterday the United States Trade Commissioner raising this issue wherein many countries are involved, including India. So I requested all the panel members to examine it from their country perspective as well. Coming back to Pillar 1 proposal, simplistically stated, the user participation approach, which is what the UK and the EU are advocating, the significant economic presence, which is what India is advocating, but India is also talking about the marketing intangibles approach, which United States is talking about. We'll pick up the debate from the OECD consultation paper document, which is called as the statement issued in 2020, because that's the last guidance that's available, also popularly called the unified approach. We will examine the profit determination and allocation, the 4-step approach under what we in transfer pricing law call it as a modified residual profit split method. The Pillar 1 summary throws up some very, very interesting challenges. What will it do to the existing set of rules, particularly the double tax agreements? How will it pan out in the context of MLI? Or are we going to see a new set of minimum standards or safe harbors that will evolve just to be able to implement Pillar 1 proposals? Will it modify the country-by-country reporting, which has already been put in place? Will we see any changes as regards exchange of information clauses in this treaty? Or will we see a one-stop shop approach where taxes will be paid by the parent company in the home jurisdiction and remitted to other jurisdiction? And then we will deal with the ABC, a very complex computational mechanism that Vikram is going to take us through, not just in terms of the economic theory and transfer pricing principles and complex use of what I labeled is the modified profit split approach methodology, but host of issues are involved, particularly when you go beyond amount A and amount B, for which we have the current set of regulations to effectively deal with the mechanism. But the amount C is an opportunity for jurisdictions to recognize profits, which we call it, are in excess of the returns calculated under B. the marketing in the marketing jurisdiction that go beyond the baseline activity, other business activities which are not a part of the marketing and distribution activity in the marketing jurisdiction, and of course the magical additional return figure. Vikram is also going to talk about Pillar 2 proposals, though briefly compared to Pillar 1. And with that, let me hand it over to Professor Dr. Robert Danon, the chair of the session, to lead us through it. Thank you very much. Welcome today for joining us.
Thank you very much, Mukesh. Thank you very much once again to the Indian branch of IFA. It's a pleasure for me to be here, both in a personal capacity and on behalf of Central IFA. We are delighted. And as you pointed out, the topic could not be more timely. Actually, it is always timely, but it is particularly timely these days. Let me perhaps make a few introductory observations before handing over the floor to my colleague, Professor Chan. I think we are in an interesting phase for various reasons. Just to remind you, the digital debate was the unfinished work after the BEPS project. And there was this small sentence in the BEPS Action 1 report stating that a possible way out could be to introduce equalization levy. Now, India, of course, made use of this proposal and introduced the equalization levy, and I understand recently expanded the scope of the equalization levy. And the debate that has been going on is a race between finding a consensus at the multilateral level and taking into account the impatience of certain countries to move forward and adopting unilateral measures. Now, this tension today is being exacerbated. You have actually pointed out the recent developments in the United States that were also reported a couple of days ago in the press, in particular in the Financial Times. These developments are, of course, of concern to the development of the international tax system. They are indirectly also linked to one topic that we discussed yesterday, which is tax treaty dodging. To what extent this can be regarded as a way of circumventing tax treaty obligation. So the question is the solution the multilateral consensus, and will the multilateral consensus be reached? And here, of course, there's a new dimension in the topic, and you will find it in the title. That's the COVID crisis. The COVID crisis has actually underscored the need for more fiscal revenues. And the question is also, and that will be picked up by the panel, to what extent this may slow or accelerate the outcome of the digital economy debate. Now, while I'm not a big fan of unilateral measures, and quite both in substance, conceptually, and from a policy perspective, the question is, of course, is the Pillar 1, Pillar 2 proposal correctly framed? And as you will see during our panel discussion, these proposals, and turning first to Pillar 1, raise a host of issues currently, one of which that was pointed out again in the context of the 20th session of the United Nations, whose document has been released recently, is the question of whether Pillar 1 proposal linked to consumer-facing businesses, is that a principle-based solution? That's also a question that arises. And then you have also the issue of fiscal revenues. Just to mention one of them, if you look at Amount B, will developing countries be satisfied with Amount B? Will they be getting enough revenues? And of course, we're touching the allocation of profit between residents and source. We're touching the arm's length principle, the separate entity approach. And of course, this raises a lot of issues and a lot of uncertainties, specifically also in the framework of the COVID-19 crisis. Now, Pillar 2 raises equal controversial questions. Remember, BEPS 1 was not about tax rates. It was about tax competition for lack of substance. And the idea was to kill artificial structures using, in particular, reinforced arm's length standard. And we saw the emergence of the value creation concept. Now, the debate has shifted more towards tax rates. And of course, the Pillar 2 proposal, as you know, includes a deduction, anti-deduction, anti-base erosion rule and an inclusion rule. The question is, does this make sense from a policy perspective, but also is it compatible with treaty obligations? Is it compatible with EU law? So all of these questions will be debated by the panel, but I think we really have to take into consideration the particular framework that we are in right now, which is the COVID crisis, and this undoubtedly will have an impact on the shaping and the evolution of this debate. So with these introductory statements, I turn to Professor Chan, who will lead us through the topic by discussing successively Pillar 1 and Pillar 2, and we'll have a panel discussion for each of these topics. So, Vikram, the floor is yours.
Thank you for that introduction, Professor Danon. So let's start with the presentation right now. So in terms of the agenda, like Professor Danon has just mentioned, I will start by discussing how the current framework looks with respect to taxing a multinational's cross-border business income. Then we will talk about the Pillar 1 debate. We will then enter into a panel discussion, which would definitely take into consideration the COVID-19 impact. Subsequently, we will move into a discussion on Pillar 2, which is the GLOBE proposal, which will also then be followed by a panel discussion, which will once again take into consideration the COVID-19 impact that was referred to by Professor Danon. So let's start and talk about how the current framework looks with respect to taxing cross-border business income. So under the current framework, cross-border business income is typically taxed in the country where an enterprise has its production factors. Now, production factors here means people, assets, people, labor, and assets. Now, the history of this framework can actually be traced back to the work done by the League of Nations in the 1920s. So in the year 1920s, the League of Nations was actually confronted with the question of how should cross-border business income be taxed. And the League of Nations essentially came out with the answer that cross-border business income should be taxed in the state where an enterprise has its origin factors. Origin factors or production factors, they mean something more or less the same. It means, once again, people and assets. Now, in 2015 and subsequent years, the OECD has once again reinforced the application of taxing cross-border business income in the country where an enterprise has its origin factors, production factors, but now the terminology is value creation factors. And this can be seen in the BEPS Actions 8 to 10 reports, as well as Action 5 and to a certain extent in Action 6. So just to give you very simple examples, if we have a company in Switzerland which is engaged in the business of selling chocolates, and if this company is making all its chocolates in Switzerland and it's selling it into a market country and deriving business income, then that income is only taxed in Switzerland and not in market country. It's taxed only in Switzerland because under Article 7 of the OECD type of model tax treaty, business income is primarily taxed in the state of residence unless and until there's a PE in the other country. And that brings to me to the next slide, which essentially says that when an enterprise has production factors in the market country, then the market country is actually justified to tax that enterprise because those production factors, people and assets, benefit from a state's legal framework as well as public infrastructure. So the benefit principle, which is a common principle found in tax law and tax policy in general, authorizes the country where the production factors are based a right to tax the cross-border business income. Now, when an enterprise is doing business across the board through certain production factors actually are linked, they are physical factors, and they could actually be a part of the same, they could be a part of the same enterprise, for example, a permanent, and could create a permanent establishment, or the production factors could be a part of a separate legal entity, for example, a wholly owned subsidiary. And the next question that arises is, how do you go about allocating profits to these production factors in the market country? And there, once again, if you look into the work of League of Nations 100 years before, as well as the work done by Michel B. Carroll in the early 1930s, the standard that was adopted was the arm's length standard. Essentially, what does the arm's length principle do is that it allocates profits to the production factors based on the value that is actually generated by them. And how is that measured? That is measured by looking into what third-party comparables would actually do. So once again, to give you a very simple example, if we have a company in Switzerland which has some value creation factors in the market country, and these value creation factors, like I told you before, they could be a part of a PE or a subsidiary. And if we assume that these value creation factors generate some kind of business income in the market country, so for example, the company in Switzerland could be selling it to the company in Spain, and then the company in Spain could be selling it to clients in Spain, then in that case, Spain has a right to tax the business income which comes into the Spanish entity. This is how the current framework essentially looks like. So what's the challenge with the current framework? And this is where we enter into the Pillar 1 debate. Now, with the rise of digitalization, many multinational enterprises have shifted away from using physical production factors towards using more intangible factors. So the use of intangibles has increased, especially intangibles that are being used by some highly digitalized businesses. Now, some highly digitalized businesses, not all, some highly digitalized businesses, the way they do business is quite new and novel. And, I don't really need to go over through all the businesses, but a lot of highly digitalized businesses, they are benefiting from collecting user data. So they collect user data, for example, Facebook or Google, and then they somehow process that data and monetize that data. So another key issue, apart from using intangibles, is this reliance on user data and engagement with consumers in general. A third issue was that because of digitalization, many enterprises can actually scale rapidly on the internet and sell into other countries. So for example, if you take a company like Netflix, is a classic example which can actually scale substantially on the internet and derive a lot of revenues from market countries without having any physical presence in the market country. So just to give you an example, so what in the digital age, multinational enterprise can centralize their activities in one country, and then they can sell in a market country with very low, limited, or with no physical presence. And if you see, there's been a shift from a market country standpoint. In the past few years, they were using their physical presence, but now that physical presence is depleting on a gradual basis. And because the physical presence is depleting on a gradual basis, that would essentially indicate that the income that is being taxed in the market country is also being depleted. So essentially, the Pillar 1 question that arises is, how can the market country tax the business income of an enterprise? Now, before we get into the Pillar 1 debate, I'd just like to touch upon one point, which is there has been this rise that is being witnessed all around the world with respect to the introduction of unilateral measures, especially digital services taxes. Now, many countries around the world, they have introduced DSTs. And in some of them, the DST has come into effect. Now, in India, already you have the equalization levy, but the equalization levy and the DST, in my opinion, is a bit different. DSTs and equalization levy, they are a bit different, especially with respect to revenue sourcing rules. A classic example of a country recently which has enacted the DST law is the UK. And UK, that DST is actually coming into effect in the UK. Now, these DSTs, they are actually applicable to businesses, DSTs which are applicable outside India. They're typically applicable to businesses which are dependent heavily on user participation. These businesses are typically the online advertisers like Facebook and Google, or they are the online marketplaces too. And the online marketplaces could be, for example, Uber, Airbnb, Booking.com, so on and so forth. So these digital service taxes, currently their scope is rather limited. So they ring-fence digital businesses. So they don't not only ring-fence the digital economy, they ring-fence within the digital economy by being applicable only to certain selected businesses. Now, these unilateral measures, as you will see in our panel discussion too, also raise several issues. First of all, these measures, they are based on the underlying rationale that users create value in certain digitalized businesses. Now, we've written extensively on this topic, and we've argued that users per se do not create value. It's the enterprise which creates value by tapping into user networks. So the policy rationale of these levies are indeed, somewhat, they can be challenged. Apart from the policy rationale, this levy triggers a neutrality issue. Now, whenever you introduce a tax, a country plans to introduce a tax, that tax needs to be as neutral as possible. But because the digital service taxes are applicable to only some selected digitalized businesses, they can breach the principle of neutrality, and the principle of neutrality is also found in the constitution of many countries. As for example, in Switzerland, which probably Professor Danon can speak about a bit later, you find this concept of neutrality, not only here, but in all other countries too. At the same time, these levies, they trigger some tax treaty issues. And at the start of the presentation, Professor Danon had mentioned about treaty dodging by states. So by introducing such digital services taxes, countries are actually dodging their treaty obligations by arguing that they fall outside the scope of tax treaties. Now, whether that's a sustainable position or not, we do not. We can only say at this point that there are extremely strong arguments to say that equalization levies or DSTs are covered by tax treaties, and hence they should be switched off. At the same time, these levies raise numerous EU tax law issues, because within the EU, you cannot discriminate non-resident enterprises, and because these levies are applicable mostly to non-resident enterprises who derive substantial revenues or whose global turnover is more than 750 million, it can somehow trigger some indirect discrimination issues. At the same time, these levies could trigger WTO as well as some trade law issues, which I'm pretty sure the panel will get into. Now, all in all, the main concern with these digital service taxes is that they are taxes which have the potential to start trade wars between countries. Now, if no consensus is reached on the OECD's unified approach, and if all countries start doing whatever they want to do, especially introducing digital services taxes, there's going to be definitely some kind of retaliation from, I would assume, mostly from the United States, and Stephanie will also allude to this point in the panel discussion. But it is very important, it is extremely important that a consensus is actually derived. Otherwise, taxpayers, especially highly digitalized businesses, are going to face a lot of tax-related nightmares around the globe. And this brings us to the OECD's efforts to create some kind of consensus. Now, the first consultation draft which the OECD had issued was in the early part of 2019. And in this consultation draft, 3 proposals were actually put forward. One of the proposals which was put forward was by actually the UK and the EU was the user participation proposal. And this proposal once again targeted a narrow set of highly digitalized businesses. For example, only online advertisers and online marketplaces. So the scope of the proposal was extremely narrow, and our team at the university has also analyzed all the public comments which were received in light of this public consultation draft. And this proposal was the least favored by all the participants who had commented on the public consultation draft. The second proposal, which was actually put forward, was the Indian Significant Economic Presence proposal. The difference between this proposal and the user participation proposal was that in terms of scope, the Significant Economic Presence proposal applied to a broader set of digital businesses. But at the same time, it applied only to digital businesses. And if you read the recent UN document that was released quite recently, a few days before, it's a discussion point on the UN agenda. There's actually an Indian government official who has actually argued, saying that the unified approach should not be the best approach to look into, but you should have a solution which focuses only on highly digitalized businesses and should not apply to other kind of businesses. But the issue with the proposal being applied to only highly digitalized businesses is that, again, it is the classic statement which has been said time and again since the digital debate, is you cannot really ring fence the digital economy. And the last proposal was the US marketing intangibles related proposal, which applies not only to highly digitalized businesses, but it also applies to a broader set of businesses which are known as consumer-facing businesses. So businesses which create substantial value in the other countries by their marketing efforts. Now, these three proposals, in one way or the other, they were combined, and this resulted in the unified approach. Now, the unified approach essentially deals with two amounts, amount A and amount B. Now, amount A is an amount which is actually an add-on to the existing system. So you have the current framework which would continue to exist, and amount A is an add-on to the current framework. And it allocates profits to various countries based on M&E Group's consolidated financial statement results. Whereas amount B and C is what we've discussed at the start of the presentation. It actually stays within the existing system, which is actually based on the separate entity approach. So if you look at tax treaties right now, or you look at transfer pricing rules, they are based on the separate entity approach. So B and C deal with separate entity, whereas A is an add-on to the existing system that actually deals with the M&E Group approach. So let's just zoom in a bit more and look at amount A and what it actually deals with. Now, in terms of scope for amount A to start would be applicable only to some multinational groups whose gross revenues would cross around 750 million euros. So the global turnover needs to exceed 750 million euros. Now, whether this revenue threshold is going to be applied on a group-wide basis or a business line basis is something which I'm not clear about, but I'm assuming it should apply on a M&E business line basis, because you can have an M&E with different kinds of businesses. If you have a M&E with different kinds of businesses, and if one business exceeds 750 million, the second business does not exceed 750 million, so the one which exceeds 750 million should be within scope, whereas the other one which is below 750 million should be outside scope. So that was at the level of the M&E Group. The second kind of, so in terms of the businesses that are being targeted by this proposal, so this proposal would apply to some businesses known as automated digital services. It essentially includes all the highly digitalized businesses which you already know about today, which is like Facebook, Google, Instagram, Airbnb, Netflix, partypoker.com, Amazon Web Services, so on and so forth. Same time, inspired from the US marketing intangibles proposal, this proposal would also apply to consumer-facing businesses. Now, consumer-facing businesses are typically businesses that generate revenue from the sale of goods or services from some items which are sold to individuals for their personal use. So a list of examples are, all the top clothing brands such as Zara, H&M, or the big fashion labels Gucci, Armani. They would be covered by them. Big companies like Procter & Gamble, Johnson & Johnson. At the same time, in the pharma industry, you can have big companies like Novartis, even cigarette companies like Philip Morris, franchise models, McDonald's, Subway, so on and so forth, would be covered by the scope of this proposal. Now, this proposal would not actually apply to certain companies, which are certain multinational businesses which have been carved out. These carve-outs are actually applicable to companies such as companies which deal in commodities, companies which are engaged in shipping and airline operations, because under Article 8 of the OECD model, you have some special rules already to deal with shipping and airline companies, as well as financial services, or at least some business lines of financial services businesses. In terms of nexus, once again, the nexus for automated digital services would be triggered for businesses dealing with automated digital services will be triggered if the multinational crosses a local revenue threshold, whereas for other consumer-facing businesses, the multinational would need to cross a revenue-based threshold plus some plus factors. So that's the difference between automated digital services and the consumer-facing businesses. Now, what these plus factors are for consumer-facing businesses is still a bit uncertain at this stage. With respect to profit determination, a four-step approach is being proposed for Amount A profit allocation. And this four-step approach is based on the consolidated financial statements of a M&E group. Now, firstly, under the first step, you would need to determine the profit margin of the multinational enterprise. Profit margin needs to be determined on the basis of your profit before tax by sales, by global sales. Now, if the multinational is above a certain profit margin, which is more than a routine profit margin, then you would, so let's just assume that a multinational is operating with a profit margin of 40%. And if there's a multilateral consensus by saying that the deemed routine margin is 10%, then the balance would be, or the deemed residual excess profit margin would be 30%. Then that 30% under step 3 would be split between a production-related margin and a market-related margin. If we do a 80-20 split, 20% of that 30%, which is 6%, will be allocated to the market. And this 6% of the global sales will be allocated to the market based on some allocation keys. Now, for the allocation key would actually be sales into a jurisdiction, but for some multinational enterprises, such as highly digitalized businesses, it could be linked to users in a jurisdiction. Now, actually, the way the proposal is going to be set up, it will also provide proper provisions or mechanisms which deal with losses. Now, losses which have been generated before entering into the Amount A regime and losses which are being generated within the Amount A regime will already be factored in. Just to give you an illustration of an Amount A allocation for a highly digitalized business. So in this example, we have the common market online advertisers such as Instagram, Facebook, or Twitter. Now let's assume they receive business income from clients, and for example, they are headquartered in country A. But the thing is, the income they receive is from business clients, but their profits that are going to be allocated of Facebook, Instagram, or Twitter, they're not going to be allocated to the country where the clients are actually based, but where their users are. So if there are the users who are viewing the advertisements in France, Germany, and Netherlands, then profits will be allocated to France, Germany, and Netherlands, and not to the country where the business clients who are actually paying the amounts are based in. So moving on, with respect to the surrender jurisdiction, so if the market countries to whom profits will be allocated will be taxing those profits, logically some entity or some country in which the multinational does business has to provide relief from double taxation. And typically, because we're talking about reallocation of residual profits to market countries, the country or the entity which will be providing relief from double taxation would indeed depend on the business model of the MNE. In some centralized business models, these could be the centralized entrepreneurs. In some centralized IP models, it could be the centralized IP owners. And decentralized business models, it could be the local entrepreneurs who actually provide relief from double taxation. The question is, what kind of method will be provided to, which will be used to provide relief from double taxation? You have, under the current tax treaty framework, you have the credit and the exemption method. But I believe that the credit method is not really a favorite method here. So what they are trying to do is they're trying to build in a new exemption method, or a method which is based on Article 9.2, which deals with corresponding adjustment. But some unique approach needs to be developed with respect to elimination of double taxation for Amount A allocations, because Amount A profits are allocated based on MNE group results, whereas the relief from double taxation has to be provided by an entity approach, by a separate entity approach. So there could be some tensions there, and I think this is one of the most sensitive points in the entire Amount A allocation phase. With respect to disputes, so whenever I think about dispute, I put them in two categories. One is on dispute prevention, and another one is dispute resolution. So on the dispute prevention side, I'm pretty sure that the guidance that is going to be provided on this Amount A allocation is going to be quite extensive, and the scope for disputes will be narrowed down quite substantially. At least that's what the OECD wishes to do. But on the other hand, I'm pretty sure that disputes will arise. That, once you have a law, the disputes will arise because there will be the way the law is worded will not be bulletproof from disputes. But the thing is, the new dispute mechanisms, whatever that are going to be developed, they cannot really be called arbitration because all of you know, and all the panelists know, developing countries, especially India, is allergic to the term arbitration. So I don't think they can call it arbitration, so it has to be called something else. But the fact is that it can indeed end up being arbitration, but it's not really called arbitration. So I don't know what it's going to be called, but a new mechanism needs to be developed. Now, in terms of implementation of Amount A, the classic way to implement Amount A is to either implement it by using the MLI, which is already there, or develop a new multilateral convention. What is the difference? So the MLI modifies covered tax agreements. So the MLI only modifies treaties, whereas a new multilateral convention would actually apply in countries even where there is even when a bilateral pair does not really exist. Now, I'm assuming that if Amount A has to be allocated, it has to go through a new multilateral convention. It cannot go through the MLI because many countries, they do not have a tax treaty with each other. There's not a bilateral pair which exists. So probably a new multilateral convention will have to be developed. Interestingly, the USA wants this to be a safe harbor, but I think there is a lot of opposition by a lot of countries around the world, and they don't really want this to be a safe harbor. So I'm assuming this is going to be a minimum standard. Now, how will the information on this Amount A allocation be reported? Probably the CBC report needs to be modified, and that once the template is modified, all the indicators which are required to make the Amount A calculations will have to be reported by the MNE, to its home state tax jurisdiction, and they will be doing that calculation based on the information reported in a modified CBC template. And with respect to payment of taxes, the idea here would be to introduce a one-stop shop mechanism, in the sense that if you take a parent company which is headquartered in the US, so the parent company which is headquartered in the US will pay the entire tax bill to the US tax administration. The US tax administration will dispatch the tax bill, the tax amounts to all other countries. That would be the idea. The key question here is, will US join or not? That's another political question. In terms of Amount B, to go through it very quickly, Amount B operates within the existing framework, and it actually wishes to standardize the remuneration that are being derived by distributors. Now, the distributors could be operating in the form of a PE or as a separate legal entity. Common theme here is that the distributor needs to buy and sell the products for resale. Now, in simple transfer pricing terms, I'm assuming that this amount would be applied to entities commonly known in transfer pricing circles as limited risk distribution entities or limited risk marketing related entities. So that's the idea with respect to the activities to which it will apply to. Now, these entities which are carrying out, entities or establishments which are carrying out this kind of activity would be allocated a fixed percentage. And this fixed percentage will be based on the arm's length principle. So currently, it's my understanding that a lot of benchmarking exercise is being done at the level of within the OECD to determine what this ALP amount is. And this is not something new. What I'm saying, it has been said in the public domain already. So certain percentages are going to be proposed. Now, the question is whether 1% will be proposed or industry differences will actually be taken in account for. Now, for example, if you have a distributor which is in the pharmaceutical industry, a limited risk distributor, the margin is not really the same as a distributor in which is selling some clothes, which is operating in the textile or in the fashion industry. The margins could be a bit different. So at this stage, we don't know much, but a fixed percentage would be allocated to the distributor. Amount C, which also stays within the existing system, also allocates profits to the existing setup of the multinational enterprises when the activities increase the base or exceed the threshold of the baseline activities discussed in Amount B. So essentially, the arm's length principle and the way it applies it within the way it is applicable within the current framework would continue to exist, in the sense that Amount C is actually dealing with an arm's length allocation to all entities of the group which are not marketing and distribution related entities. Now, this return is based on the arm's length principle, so there's not much to say about Amount C, because Amount C is the arm's length principle as you find it as applicable in the current system. To take you through a very quick example, and I will just take 3 or 4 minutes to go through this quick example. Let's just assume a situation where you have a US multinational that has set up a centralized business model in Switzerland, and the US multinational licenses all its IP to the Swiss company. The Swiss company pays an arm's length royalty to the US parent for conducting its activities in the European region. Now, this principal entity is operating with, let's say, toll manufacturers, contract R&D service providers, and it develops certain products, and it sells these products in the Dutch market on a remote sales basis, in the German market by using a limited risk distributor operating on a 2% on sales basis. So when I say 2%, it's operating profits by sales, and then it's operating through a full-fledged distributor in France, and let's just assume that the ALP is 8%. it's reporting an 8% margin. If you just take a very simple example here, based on let's just assume that the M&E Group's consolidated financial statements show that the group operating revenue is 1 billion, the consolidated expenses is 600 million. So that means the profit would be, group profits is around 400 million. And let's just assume that 10% of the global revenue is derived from Netherlands, 20% from Germany, and 30% from France. In this situation, if amount A is applicable based on a 20/10 approach. So the current approach that is being favored, or I've heard about recently in a presentation, is actually a 10/10 approach. But let's just assume this is a 20/10 approach that is being followed. Now, what does this actually mean, 20/10 approach? Let me just explain it to you. Is that under step 1, you would see that the group EBT margin is around 40%. So the group profit is 400 million divided by 1 billion of sales. So the group EBT is 400 million, or the group EBT margin is 40%. So under step 2, the deemed routine EBT margin, let's assume it's fixed at 10%. So this is the basis I'm making my assumption on, that the deemed routine margin is fixed at 10%. So 30% of this 40% will be allocated to a deemed non-routine margin. Now, 30%, which has been allocated towards the deemed non-routine EBT margin, will be split between production-related activities and market-related activities, in the sense that 20% of the 30% will be allocated to market countries. So essentially, 6% of the EBT margin will be allocated to market-related activities. And under step 4, the group's amount A profits would essentially amount to 6% of the overall revenues. That would be 60 million. So 1 billion into 6% would be around 60 million. And the 60 million would be reallocated to the different countries based on the sales that have been derived in all the countries. So like I mentioned to you, 10% of the sales would be are from Netherlands in our example, so they will be allocated 6 million, 20% from Germany, so it will be 12 million, and 30% from France, so it will be around 18 million. But there could be some overlaps between the sales done in France, that is the amount C, and then also amount A, because France is already doing full-fledged distribution activities and booking residual profits. So that's how amount A would work in a very simplified way. So essentially, the objective, I think, which the OECD also wants to pursue, is that the amount A calculation needs to be as simple as possible, so that it can be done by using a simple Excel sheet and nothing more. Now, amount B would be applicable in our case, and amount B would typically apply to the limited risk distributor in Germany, which is operating, let's assume, doing only low risk distribution and marketing activities, whereas amount C would apply to the full-fledged distributor in France. The amount B taxable base, if we assume that 2% on local sales is the arm's length remuneration, would amount to 4 million. Now, interestingly, in the statement that was issued by the OECD, they said that there are no overlaps between amount A and amount B. And I think that's somehow a bit true, because amount A deals with allocation of residual profits, whereas amount B is talking about allocation of just simple routine profits. Whereas on the other hand, there is clearly an overlap between the amount A taxable base that has been allocated to France and the amount C taxable base. Because in France, if we assume that the arm's length remuneration of the local distributor is 8% on sales, that means within France, there's already 24 million of revenue that is being reported. So there could be some overlaps between amount C and amount A, and possibly in this kind of situation, amount A would not really be applicable in France. So there is tension between amount A and amount C, which needs to be sorted out. So post Pillar 1 exercise, there would be an amount A liability in the Netherlands. Amount A and B would be allocated to Germany, and amount A and C would be applicable in France, and there would be some kind of tension between amount A and C. Now, because all the profit has been allocated to the market country, especially for amount A, the question is which entity in the group would provide relief, or which country? And here I'm assuming that the relief will have to be provided by both US and Switzerland, because they are the residual profit owners within this kind of multinational setup. And I think I'm going to stop here, and I'm going to hand over the floor now to Professor Danon.
Well, thank you very much, Vikram, for these interesting thoughts. I think you perfectly portrayed and described the unified approach, and much so also the complexity of the approach and the question it raises, both from a conceptual point of view, from an implementation point of view, and from a capacity building point of view. And here I'm also thinking in particular of developing countries. Well, I guess we will open the floor right now with questions. And I will start by giving the floor to Professor Guglielmo Maisto, one of the well-known IFA friends, member of the chair of the European region of IFA, for your thoughts, Guglielmo. So please, the floor is yours.
Thank you very much, Robert, and good afternoon and good evening to everyone. Yes, indeed, I shall focus on the scope of amount A and the borderline issues, one of the questions which quite rightly are being raised. And first of all, about consumer-facing business. I believe that the debate is much broader than that. In many countries, it may be difficult to justify a difference between taxation of consumer-based or consumer-facing businesses and other businesses, even if we consider the benefit principle, which in some countries does coincide with the ability to pay principle. If the point is that the benefit principle is providing a market, then also non-consumer facing businesses should be treated like consumer facing businesses. So in principle, I believe that there is a difficulty for some countries to actually have different treatment between consumer facing and non-consumer facing. The second point, assuming that consumer facing is the focus in accordance with the Pillar 1, I would say that consumers should have a broader definition, include also business to business, and the basis for that, the justification for that should be the ratio of marketing expenses. I think one of the issues which have been raised is related to how to define and segregate a consumer-facing business in the context of Pillar 1. And I believe that one of the areas to be explored will be the connection between the marketing expenses and the sales in a particular jurisdiction. And one could also consider the possibility to have the taxpayer to provide contrary evidence insofar as the ratio between a marketing expense and sales fits into the ratio required for Pillar 1 application, but there are good reasons for the taxpayers not to be included. That would provide some level of flexibility. As to information required in order to determine whether or not the ratio is observed and is met, one could consider to include such piece of information into the country-by-country reporting. The issue would remain to the definition of marketing expense. That would be, in any event, an objective way of determining a consumer-facing business. I'm not in favor of having a list of industries, because that list will become very, very soon obsolete, and therefore it will be difficult to apply and reconsider an update of a list of industries which will be regarded as consumer-facing businesses. So this is basically my consideration regarding the consumer-facing issue, which I believe is a bit behind compared to the other areas of the digital services, and you have evidence about it in the domestic legislations which have addressed so far in some jurisdictions digital services, but not consumer-facing business. Thank you.
Thank you very much, Guglielmo. What I suggest doing is actually take a first round of discussion by the panel, and then we can have some closing remarks. I think your thoughts are very important, and then we'll come back to it. But I think it's good that we have a first round of discussion. Next, I have the pleasure to welcome Dr. Peter Brühlsauer, who is a well-known and a personal Swiss friend. So I'm very happy to have another Swiss on the panel. Not that I feel particularly lonely, but it's always nice to have a second Swiss who might perhaps give us a perspective on the unified approach, and also perhaps also what it means for smaller countries such as Switzerland. Peter, it's very nice to have you. The floor is yours.
Thank you, Robert. Also from my side, I welcome you to this webcast, and I'm happy to give you some insights from a Swiss perspective. So first, what kind of changes will need to be implemented? How should these changes be implemented? We have heard when we talked about, or when Vikram talked about the different amounts, we have amount A that deviates from the dealing at arm's length principle. We have amount B and C. So here we have now, we have a deviation from an overall perspective from the dealing at arm's length principle. So we need to have a new nexus rule that is allows us to allocate some profits to the market jurisdiction. So we need the nexus rule. On the other hand side, then we also need to have the rule, how do we make the allocation? So we have the allocation rules that need to be implemented. And then, of course, we also have to find a way how any double taxation or double non-taxation can be avoided. So these are the three issues I believe that have to be implemented somehow in the legislation. What, how, and in which legislation? For me, or from a Swiss perspective, where we apply we need to have a strict legal basis that you really can allocate taxing rights, so that you can levy taxes. So that means you need to have these changes on the nexus rule, on the profit allocation, on the avoidance of double taxation in the unilateral law. So we need to have a unilateral basis so that we can allocate profits out of Switzerland. Then secondly, we need to have these rules also in the bilateral law. And of course, then in this question, if we apply bilateral law, is it just a double tax treaty, or is it a new multilateral treaty? I agree with Vikram, what he said, it's not the current BEPS MLI, it would be a new multilateral treaty. And in light of the fact that really this Pillar 1 concept works at the end of the day, and to make sure that we really have a consensus and that we have a uniform allocation, which I believe is very necessary, that it is applied by all the states and so on. So I believe the multilateral agreement, the new multilateral agreement might be the right way of doing so. What exactly needs to be changed? I do not believe, so we have a new nexus rule. I do not believe that we change or we should not change the P definition. So this should be a complete different nexus rule away from the P definition, because we have other provisions in the double tax treaty which make reference to the permanent establishment, for example, the 180-day rules and so on. So here we have really a new nexus which we have to implement in the unilateral law, in the multilateral law, and then it's also the same from a profit allocation perspective. If we look at Article 9 of the OECD double tax treaty, and if we look at the unilateral law where we deal with deemed dividend distribution, there we have a new a rule which really allows us to make the deviation from the dealing at arm's length principle. So that's about how I would see it, the legal implementation to be done from both a unilateral and bilateral, respectively, multilateral perspective.
Thank you. Yes, please.
Whether COVID-19 would change the allocation regarding amount A, to be honest, I'm somehow skeptical because how do the amounts at the end of the day, what do they depend on? They depend on the scope, they depend on the exclusions and many other things. And if we now add additional layer just because of COVID-19, how long will COVID-19 last and so on? So I would not believe, I'm skeptical that this COVID-19 should change the allocation or should even add a higher profit allocation to the market. And then last but not least, to the third question, with respect to the amount C, in fact, yes, it seems to be a little bit unclear. Is it just an amount that which for marketing and distribution activities which are beyond the baseline on amount A, or is it much more, it refers to all other businesses are performed in the market countries which are not linked to marketing and distribution. At the end of the day, in any case, as I understand, it's based on the functional analysis. The amount C should not deviate from the dealing at arm's length principle. So I see it more in that way. We have this dealing at arm's length principle, and in light of the fact that with these regulations we also should have a more effective dispute resolution mechanism, I would even more expect dealing at arm's length principle, and then an efficient dispute resolution, and then we should hopefully get in a reasonable amount of time to the right result. That's about my perspective for this first questions.
Thank you very much, Peter. We will come back to these points. Luis, welcome to the panel. I have a question for you. Among commentators, it was recently suggested, and the idea was picked up, that the unified approach and the Pillar 1 project, already complex in itself, should be complemented by a Pillar 3. And that was, a proposal that was articulated in the framework of the COVID-19 framework. So what's your perspective on that?
Thank you, Robert. Thank you for your question. Well, first of all, I must say that I'm also skeptical, just like Dr. Brusauer said. So I do not believe that this Pillar 1 will be implemented in the short term. I don't really believe it will be implemented ever. So let's say, what we are talking about, the international tax scenario for 2023, not for the present century. So maybe most probably we are not going to see the results. We're talking about future? Well, let's assume this is clear. You see the MLI, which has a narrower scope. You have several countries which have never signed it, and those who signed it made several carve-outs. So to imagine a consensus on Pillar 1, it's a dream. So it's a brave new world. So by saying this, I can already immediately answer to you, since I don't believe in Pillar 1 for this century, and since I hope COVID-19 will not exist in century 23, so we are talking about something which will most probably not happen. So, but coming directly to your question, so how I see this, well, just for the audience to remember, this idea was presented by Professor Alison Christens and Tarcísio Magalhães, motivated both by the current fiscal crisis due to the COVID, as well as by the claim for developing countries for bigger share in the allocation of taxing rights. It's a novel idea. Well, the idea, they claim that due to COVID, some companies might see super profits that have nothing to, or would have nothing to do with their activities. This would be a rent derived from a market failure, much in the same way as a monopoly creates rents or even carbon emissions that creates costs shared by the entire society. So the fact that this profit would not be attributable to the company's activities would justify that they would be treated differently. If you add the excessive fiscal pressure due to COVID, you see what's the main idea from there. So they assume to calculate the super profits, which would be something beyond the routine and the routine profits. So this is really something not very new. If you get Pillar 1, you already see, and we have seen now, Professor Chen, you see the routine profits, amounts B and C, you see the residual profits. The residual profit is calculated on the excess over the routine profit. And there is, as already said, not an exact definition what the routine profit would be. So, of course, it's not very easy to know what would be this residual profit. Much in the same way, the definition of super profits would be based on a compromise. The sum of routine and residual profits is presumably constant over the time. If the company sees its profitability skyrocket, this deviation would represent a super profit. So it's clear that we have an overlap between pillars 1 and 3. Just to get an example, imagine that in normal situations, a taxpayer would have routine profits of 8% and assume residual profits would be 12%. So if you apply pillar 1, you'd have 8 for amounts B and C, and 12 for the amount A. So you have 20%. Now imagine that in 2020, because of COVID, the taxpayer saw its profitability skyrocket to 100%. So in 2020, the residual profit would be in excess over the routine profit of 8%, which would be 92% residual profit. And the super profit in the same year would be those which would be beyond the 20%, which would be 80%. So we can see an overlap of the 80% super profit and the 92% residual profit. So it means we are going to have a double taxation on the same income. And then comes the whole question. If we are taxing income, should we have a super profit taxation, or should we simply consider that there's more ability to pay, you already pay more taxes, you may even consider or not whether you're applying some progressive rates, but it's very difficult for me to see in the field of income tax, while we are still taxing income, whether there should be any super profit taxation. So I would not support the pillar 3 as a new idea, or if we're talking about income tax. Once again, this is something for the century 23, and hopefully century 23, we will not have COVID anymore. So it's just an academic discussion anyway. That's it, Robert.
Thank you so much, Luis, for these penetrating thoughts. I guess The energy with which you expressed these thoughts made me, at some point in time, think that I was back in 2017 in the Congress in Brazil, listening to your thoughts on subject to, also on transfer pricing, but we didn't have the COVID crisis and we didn't have the unified approach back then, but we still had your energy. So thank you so much for this. Before turning to the chair of IFA India, I'd like to somehow get now to Professor Schwartz, Jonathan Schwartz, a dear IFA friend as well, and Stephanie Johnson for a perspective on the other side of the story, namely the rise of digital services tax and the fact that these taxes, on the one hand, potentially conflicts with tax treaties. Remember, for those of you who were there with us yesterday, I have argued that the BEPS initiative has put a stronger focus on purposive interpretation to detect abuse by taxpayers with the introduction of a PPT. The question, of course, is should we have a more purpose-oriented or a more purposive interpretation of tax treaties also to prevent tax treaty dodging? And the question, of course, is to what extent these types of taxes are in friction with the scope of tax treaties, in particular Article 2. So this is the first question that I'm going to address to Jonathan. And then Stephanie, of course, I cannot resist but ask you about what you think currently with the US position and the ongoing possible investigation into several digital services tax and possible retaliation measures under US law with respect to these taxes. In other words, will French wines be at risk? So that's the question. But first, I'd like to turn to Jonathan for the issue of compatibility, in particular with tax treaties. Jonathan, the floor is yours.
Thank you very much, Robert, and thanks for the invitation. Well done to IFA India. Really excellent achievement on a fascinating topic and, as I understand it, huge attendance. One's got to take a realistic view of digital services tax, I think, including that in the UK. Vikram has already pointed to the fact that a large number of countries have introduced digital services taxes already, and I think that this is going to proliferate. The only effect, seems to me, of COVID-19 is that it is accelerating trends that we have already seen. So the fact that this is an online event is a trend which I think was en route in any event, and I think the same is true of these kinds of taxes. The need for revenue is going to mean the need for new taxes. The second reason that we need to be realistic is that if we go back to BEPS Action 1, what we saw in terms of potential solutions to digital economy challenges were four things. The first is the modification of the preparatory or auxiliary activity rules. Well, that has been done as far as it is accepted in the MLI and in post-2017 treaties. The second is alternatives to the existing PE threshold. Well, this is really the nexus question of Pillar 1. And then we get to two other items. The first is the imposition of withholding tax on certain types of digital transactions and the introduction of an excise tax or another levy. And really this is where the digital services tax comes in. Exactly where the taxes fit in between those two items doesn't really matter in a way because they tend to cover similar grounds. The reason why we're seeing them, and perhaps the advantage from countries' perspective of digital services tax, is it is unilateral. Unlike Pillar 1 in particular, which requires a large amount of buy-in at a very detailed technical level for it to succeed, digital services taxes and excise levies of a variety of kind can be introduced by states, and they are doing that increasingly. This is obviously giving rise to tensions, particularly with the US, that Stephanie's going to talk about. As far as treaties are concerned, again, I think that while I share Robert's view about treaty dodging, and certainly in the UK, we've got a direct read across to the diverted profits tax, which is also designed to be outside tax treaties. Whether they are or not is another matter, because there's a tension between that type of legislation and the language in Article 2 of the model treaties, which says that treaties apply to taxes on income on capital, however they are levied. It doesn't really matter how you label the tax, at least as far as Article 2 is concerned. If it is an income tax, then it is within Article 2. So that is something that is going to play out in the courts and is going to take some time. But there is another important trend that I think should not be forgotten, and that is, in any event, the increasing desire reflected particularly in the UN model for source country taxation. And its most obvious manifestation is in the new Article 12A, which deals with technical services fees. And there you can see that there is probably less tension between treaties that might adopt that article and those that adopt the more traditional Article 12 definition of royalties. Is this temporary or permanent? There's a lot of discussion that a Pillar 1 type approach will make digital services taxes redundant. Well, all I would say there is that there is a tendency for temporary taxes to become permanent. Income tax was invented in 1799 as a temporary tax. It has been around permanently for 200 years and shows little sign of going around. The EU adopted a temporary mechanism for intra-EU transactions in goods in 1992. There's no sign of that disappearing. So my guess is it's going to be around for a while.
Thank you very much, Jonathan. Yes, it is. It is going to be, might be indeed around for a while. I would not like to go to Stephanie. Perhaps I think you're the best person in the panel placed to try to assess what's going on and the dynamics, not necessarily from a technical perspective, but more from a policy and political perspective. What's going on in the U.S.? How is the U.S. reacting to the proliferation of digital services tax? I mean, this is not a new item. It's certainly an item which, as Jonathan has mentioned, is being currently exacerbated, and I would very much appreciate to have your thoughts on that front. Thank you very much.
Hi, thanks so much for inviting me to the panel and for this great conversation. It's so timely, and I am very honored to be here. So yes, to pick up on what Jonathan was saying, you know, what we're seeing now is this, many countries are going into extreme debt right now to pay to keep their economies afloat. And, you know, this pandemic has exacerbated those problems of for tax revenue, the tax revenue losses and the need for tax revenue. So the fact that, you know, we are here on this call on a virtual platform talking about digital economy, many countries are starting to look at that and saying, you know, these companies who have digital services are doing really well in this pandemic, so we need to tax them first. They're the first in line to get taxed because they're doing well, versus traditional brick and mortar companies. So this narrative is starting to become more apparent. The French finance minister has mentioned this in public several times. The Indonesian finance minister, she actually referenced Zoom and other Netflix actually in her as announcement that they were going to go ahead with this electronic transaction tax as an immediate response to the coronavirus pandemic. So, you know, a lot of countries are using this pandemic as a justification now for introducing unilateral measures, pending the outcome of the OECD solution, which negotiations are in that regard also kind of delayed because of the pandemic as well. And so, it seems that companies are sort of ring-fencing themselves. This is something that Pascal Saint-Amand, the OECD tax chief, has mentioned in public very often, that countries are starting to see companies as, prime targets for digital taxation. So that brings me to the U.S. The U.S. is not like this at all because, many of these companies that are often mentioned, the GAFA companies, Google, Amazon, Facebook, Apple, are American. So as you may have seen in the past, actually in the past couple of days, that the U.S. Trade Representative has announced that it's investigating the digital services taxes of 10 trading partners. This covers Austria, Brazil, the Czech Republic, the EU, India, Indonesia, Italy, Spain, Turkey, and the United Kingdom. Now, you might remember in last year that the USTR had investigated France's digital services tax, and found that that tax was discriminatory against U.S. companies. So, the U.S. threatened to impose tariffs of up to 100% on with some $2.4 billion worth of French goods. So champagne, cosmetics, all the stuff I actually enjoy. So that was a very high point in the tension between the U.S. and the rest of the world on the digital taxation front. So now we have this new round of investigations that was announced on Tuesday. Now, this wasn't a surprise because when the U.S. Came out with the final report on the French digital services tax, they actually warned that they were going to look into Austria's, Italy's, and Turkey's digital taxes. But what was surprising about this investigation was that it covered way more countries than what we expected, and actually covered countries that only are merely in the discussion phase of introducing digital taxes, which is Brazil, which only recently submitted legislation to the Congress for consideration on a digital services tax of their own. And so India's equalization levy is also a target. As you all know, there's 2% equalization levy that took effect April 1st. We've also got the Czech digital services tax, which is waiting for parliamentary approval. The UK's digital services tax is also awaiting approval. So, in the aftermath of this announcement, which kind of took everybody surprised in the timing of it, because we were all in this pandemic, and we all didn't, everyone sort of expected, trade wars to be something to think about in the future, because this is kind of a bad time for trade wars. So, what I'm seeing right now is that countries are not at all worried. They're still holding fast, digging in their heels on their taxes. For example, just today, Spain said that Spain's parliament voted to go ahead with a 3% tax on revenues of online advertising, online platforms, and so user data. So the lower house voted today to start legislating for it. So obviously, these countries are still sticking fast to their plans. Now, this whole situation it adds a lot of pressure now to the OECD negotiations, especially on Pillar 1. So that really is going to light a fire under them to get something agreed by October. You may have seen that the inclusive framework on base erosion profit shifting, which is responsible for agreeing on this solution that Vikram so eloquently described earlier, that's supposed to be happening in 2020, by the end of 2020. They were going to meet in July, but because of the pandemic, they can't meet physically, so they started to October. Whether that's going to be a virtual meeting or a physical meeting remains to be seen. So it's going to be an interesting few months. The next few months, because on the one hand, the U.S. really does not want digital services taxes to apply to their companies, yet they are asking for Pillar 1 to be implemented on a safe harbor basis, which we understand to mean the U.S. wants it to be an optional solution. So companies could either opt into Pillar 1 or face a whole slew of digital services taxes. And the way things are going now, it seems like slew of digital services taxes is what's going to happen. So Pascal Saint-Amand had mentioned publicly that this pandemic may have an effect on international trade, as it seems to be pulling some teeth out of the mouth of Section 301, which is the provision in the U.S. Tax Act that allows the U.S. to punish countries that they find to be discriminating against U.S. companies. So no one wants a trade war right now, especially because of the dire economic needs that countries have right now to pay for their pandemic recovery. It also throws a wrench into the UK's and India's efforts to negotiate trade deals with the U.S. Brazil is also seeking OECD membership, so the U.S. is a big say in that. So it's sort of hard to say at the moment whether the U.S.'s probes will discourage these countries from abandoning their taxes. At the same time, these countries are also facing a lot of anger from the public, because they see these companies who didn't pay a lot of taxes before. In their view, they didn't. The public is starting to really, I think they were starting to see that, hey, we should really crack down on these companies. We really need to put pressure on the government to do something. So, that momentum might get something agreed to be by the end of the year. So, on the other hand, the U.S. is its own thing. And the U.S. is sort of a wild card, I guess, because we also have an election coming up in November. So who knows in the implementation phase, if something is agreed, how is that going to implement? Or how are they going to implement? How's the next administration going to implement it? So a lot of outstanding questions, and it's been really fun covering it. It's kept me busy, so I'm very much looking forward to what will happen next.
Thank you very much, Stephanie. I'd like now to give the floor to the chair of IFA India, Mukesh Bhutani, and perhaps direct a question to him as well. You have, of course, many observations to make, Mukesh, particularly from an Indian tax policy perspective. I think one issue, if we return to the Pillar 1 proposal, one issue which arises is whether the developing countries will get enough share of fiscal revenues through the proposal. And if you look at the documents that were attached to the 20th session of the Tax Committee of the United Nations recently, you see that this concern is again echoed. I mean, it's not new, but the question is echoed. I mean, typically that amount B should lead to a fair allocation of taxing rights, and this, of course, is balanced with the complexity of the proposal. And so I think one part of the equation, of course, is to what extent developing countries will be satisfied with the allocation of revenue, and this is, of course, another point of friction. And this is just one of the questions I have for you, and in addition to the observations that now you're going to make from an Indian policy perspective. So, Mukesh, the floor is yours.
Thank you, Robert. And as you correctly pointed out, the reservations that have been expressed primarily by emerging nations, including India, with the United Nations, is more on what is called the fair allocation of right. But before I get to the A, B, C and part of it, I just wanted to add, particularly for the benefit of our overseas participants, as to where does India stand from a policy perspective. First of all, we should recognize that all moves made by India, which are targeted to expand its tax base, asserting its right on fair allocation of income, extends far beyond the digitization of business. If you look at the significant economic presence, the definitions are no longer restricted to the digital models, because historically India has had faced a lot of disputes between the taxpayers and the tax administration on what is the fair basis for allocation of profits to permanent establishment. And this is typical brick and mortar model, not necessarily digital model. Of course, we've seen a surge in litigation on the digitized model in the last few years, but we've had a lot of litigation in the area of the brick and mortar model. And that's where what explains the policy stance. The other aspect is the divide then between what the policy dictates, how the administration implements it, and how the judiciary looks at it. So judiciary view historically on permanent establishments and allocation of profits on permanent establishment, including for digitized businesses, has been largely favoring the taxpayers and doesn't necessarily agree with the views that are held at the policy level. Now, coming back to the debate on Pillar 1, Pillar 2, we've kind of muddled up a little bit from a policy point of view for the following reasons. Number one, let's look at the consistent part of it. The principled approach, the so-called OECD authorized approach, has been done away with. India also, disagrees with that. So now we have two approaches before us from a policy standpoint. One is the formula-based approach, which is what we call it as the formulatory or the fractional apportionment method. India uses that term and used that term when it put out a draft consultation paper in April last year to deal with how you go about the fractional apportionment method, which is very different than the approach that is being recommended by Pillar 1. And the second is really the mixed approach. Now, interestingly, even if you go by giving putting the arm's length principle on the side and going about taxing digitized business models with keeping in mind the market jurisdiction, what are the various aspects you look into it? So user participation, marketing intangible, and SEP, which are departing from the separate entity approach used under the arm's length principle, are really pointing out to opt one or a mix of another. So let's look at the two proposals. One is the proposal that has been put forth by India's Department of Revenue by way of a report, and second is a unified approach that Vikram talked about under Pillar 1. Both are suggesting clearly that you go beyond the arm's length principle. Both proposals also recognize, India's proposal and Pillar 1, that value creation in the market and the user jurisdiction should be the basis to allocate profits. Now, I know Vikram did specifically highlight the fact that users don't necessarily create value creation. That's why for Indian purposes, that stands modified, and that's why I'm calling it as a market/user jurisdiction. In my view, a mixed approach is the way forward, and I really compare the mixed approach to the modified profit split approach, where you use the appropriate allocation to assign non-routine profits to market jurisdiction, where functions can clearly be categorized into routine and non-routine. Now, this will give rise to disputes in India as to what is routine and what is non-routine. And the reason this will give rise to dispute is that we already have a spate of dispute on marketing intangibles, where the limited debate is what is routine and what is non-routine. Now, the non-routine functions, leaving aside that debate, could further be divided based on trade intangibles, patents, technologies, so on and so forth, and marketing intangibles, which would be the trade name, the customer relationship, so on and so forth. Now, in my view, global consensus is key, because otherwise it could lead to chaotic situations, because though India has not officially said that the equalization levy is a unilateral measure, a temporary measure, and as soon as the consensus is arrived at, the measures will go away. We also have very limited guidance as to what our significant economic present test look like. However, we need to be patient and wait and see how does the consensus arrive. And if global consensus is on the way forward, then I think that is what Indian policymakers would ideally prefer. Now, there would be variations that many countries will have. I can say with confidence that there would be variation in India as well. But to what extent is that variation permissible, or to what extent will that variation result in double taxation, which is a question, Roberto, you have also raised on the arbitration mechanism under Pillar 1. So let's assume that Pillar 1 becomes a reality with minor variation for India. I don't want to get into the debate on arbitration because that's been debated and dusted to a larger extent. Suffice for us to move forward that India would continue to maintain its stance against mandatory arbitration, and hence that is unlikely to happen. Now, what are the options that are available before India if Pillar 1 becomes a reality, and as a result of Pillar 1 there are some variations that India may want to bring about in its domestic tax policy? Leaving mandatory arbitration question on the side and taking an overall view, I think that there are a lot of prescriptions that are available before Indian policymakers. Number one, and it was heartening to see and hear some of the former Department of Revenue officials talking about an alternative to mandatory arbitration, which is some form of a mediation process. And the speculation for some form of mediation process has gathered momentum because last year it was being talked about in the context of the new direct tax code. Now we need to see that become reality in our local statute as a credible option to mandatory arbitration under the treaty. But I'd just like to make one important point, which is arising of the MLI commitments. And reading the MLI document, it gave me a good reason to question as to why India, specifically in the context of Article 16.2 of the MLI, is silent. It has not expressed a reservation either. Number one, Article 16.2, just for reminding everyone, an obligation on part of the competent authority, which goes far beyond the obligation that we see under Article 25 of the Model Convention insofar as the MAC process is concerned. Because this becomes Article 16.2 and 16.3 read together becomes the joint responsibility of the competent authorities to be able to deal with the issue of some form of an obligation, not a obligation by way of mandatory arbitration, but obligation to resolve a dispute. Now, those disputes could occur either in the context of friction between the domestic law and the treaty, application of principal purpose test, but specifically, given the topic that we have in our hand today, it is bound to occur in the context of Pillar 1 proposal. So I'd rather stop over there. But I also wanted to raise a question that came about in the Q&A box, and perhaps Vikram or anyone else can take this question. It's a very interesting question. This is regarding Amount A. It says how feasible it is to tackle consolidated financial tax and accounting adjustments that would be needed to achieve a fair taxable basis. And how would subroutine profits be treated? I think he means to say, how would non-routine profits be treated in the context of Amount A? So I don't know, Roberto, as the chair, if you would like to debate this question before he moves to the Pillar 2 recommendations, the proposals. Thank you.
No, I think Professor Chan is dying to answer the question.
Yes, so thank you for the question. To determine an Amount A allocation, the starting point is the consolidated financial statements. And if you look at the consolidated financial statements of a multinational, there could be some items which are related to some special expenses. And one of the things that comes to my mind is expenses incurred in, for example, acquisition of another business. So some kind of adjustments will have to be made to the consolidated financial statements. And at this stage, I can just say that some adjustments will need to be made. Now, what those adjustments are, we'll need to wait and watch, but adjustments will have to be made to determine the appropriate PBT number. Now, to determine that appropriate PBT number, it's like when you're doing, just to put things in a very simple way, when you're calculating your profit margin, when you're dealing with transfer pricing rules, when you're applying the TNMM, the transactional net margin method, you also make certain adjustment for example, extraordinary expenses or extraordinary income. Now, similarly, to the extent these kind of expenses are reflected in your consolidated financial statement figures, adjustments will also have to be made to determine the appropriate profit before tax of the multinational. And the way the system is going to be developed, it will also take into consideration losses. Now, losses which exist before the regime is effective and losses which are built up from the date when the regime comes into effect. Now, the details of this are already examined in a paper written by Professor Danon and me in our comments that have been submitted to the OECD on the November consultation draft. So if you want to have a look at an example of how it works, so I would just refer you to that paper.
Thank you very much, Vikram. I think in the interest of time, we will be moving now to the discussion on Pillar 2. I will ask you perhaps to be a bit more brief on Pillar 2, and just a small housekeeping matter. Professor Guglielmo Maisto has to leave, has a time constraint, so I suggest that we will debate Pillar 2, and then we'll give Guglielmo the floor. So please, Vikram.
Okay, so let me continue with the discussion on Pillar 2. Now, at the start of the presentation, I had mentioned to you that under the current framework, business income of an enterprise is taxed where that enterprise has its production factors, as typically people and assets. Now, the concern with a system which is based on production factors is that production factors are mobile. So a multinational can easily move people from a high tax country to a low tax country and engage in profit shifting activities because people are mobile. So you have some people in the US where the corporate income tax used to be 35, now 21. They can still move them to Cayman Islands and achieve a tax rate of 0%. So multinationals can still engage in profit shifting in the post-BEPS world, but now the profit shifting is genuine profit shifting. At the same time, countries can compete with each other. Now, compete, I think it's already quite well established across the world that many countries, they compete with each other to attract production factors. And one way a country competes with other countries is by entering into tax competition, especially with respect to reduction of corporate income tax rates or abolishing withholding tax rates. So it's a given fact that countries compete with each other. So because of this mobility of these production factors, businesses could be tempted to move these production factors from high tax countries to a low tax country and still engage in profit shifting, and countries at the same time can engage in tax competition. The question then for Pillar 2 is essentially, how do you combat profit migration to low tax countries and this race to the bottom mechanism? Now, with respect to the race to the bottom mechanism, you should know that there's been this gradual decline in corporate tax rates since the past few years, and that's the reason why it has been highlighted as an issue. So what is Pillar 2 proposing? So Pillar 2 is proposing main rules, or I call it main rules, and then some supporting rules. The main rules are typically an income inclusion rule and a base eroding payments rule. So in this example, if you have, let's say, an entity which is in the Netherlands and which is carrying out value creation activities, but for example, if in the intermediary jurisdiction where it's carrying out its activities, it's paying a very low effective tax rate, for example, because it has access to a BEPS compliant Action 5 regime on patent boxes or some other kind of regime, or just generally because the corporate tax rate is low in that country. So if the corporate tax rate is lower than 12.5%, I've used 12.5% because I was inspired by a webcast of the OECD. So I've plugged in this number of 12.5% here, but this number is still up for negotiation. Now, if the tax rate in the intermediary country is less than 12.5%, then as a priority, the income inclusion rule would be applied by the state of the parent company. And this rule actually has been inspired from the US GILTI. And if the state of the parent or the state of the headquarter does not really apply the income inclusion rule, then the state where the payments are coming from, that is, for example, in our example, France could actually apply, could deny a deduction for the payment that has been made to a low tax jurisdiction. And this somehow has been inspired from BEAT. So apart from a denial of deduction mechanism, I think another mechanism that is being contemplated is something known as a reverse CFC rule. And this information is again in the public domain. So this is how the Pillar 1 main rules would apply. And in order to apply these main rules, firstly, once again, an M&E group revenue threshold will need to be passed before these rules are before M&E falls within the scope of these rules. For example, these rules would somehow be similar to the Pillar 1 threshold in the sense that they would be applicable to M&E groups which exceed a global revenue threshold of 750 million. And once again, the starting point to determine the effective tax rate or to calculate the effective tax rates, once again, the starting point could be the consolidated financial statements. And there could be some coordination with Pillar 1 here to determine this. But when I say consolidated financial statements, it's also dependent on the approach that is being adopted by the country on blending. And this is a very interesting point because the approach adopted towards blending, whether it's a global blending or a country-by-country blending approach, would actually have a lot of knock-off effects, including determination of the tax base or the effective tax rates. So under a global blending approach, a multinational's headquarters jurisdiction's tax rate is compared to the tax rate it pays on a combined basis outside the country outside its home jurisdiction. If the tax rate is less than a lower threshold, the effective tax rate 12.5%, then a top-up would apply in the parent in the state of the headquarters. Whereas the country-by-country approach, it actually looks into the effective tax rate paid in each country. And if that falls below a certain threshold, for example, 12.5%, then the state of the parent would be allowed to reallocate the income back from that country of the low effective tax rate back into the home country jurisdiction. Now, there is also some carve-outs that are being discussed, and in my opinion, the carve-outs would actually be dependent on whether a global blending approach or a country-by-country approach is actually adopted. Now, if a global blending approach is adopted, I don't really see policymakers going ahead and carving out some substance-based activities. But on the other hand, if a country-by-country approach is adopted, a jurisdictional blending approach is adopted, I would certainly see a carve-out for some substance-based activities and also some routine profits on deemed tangible income. So the global blending approach, at least this is my understanding, is the same approach applied by the US. But at the same time, the country-by-country approach is somehow being pushed by France and Germany. Once again, I'm saying this because the information is there in the public domain. Now, in terms of the rule order, I think the way it's going to work is that it's going to work is that the state of the parent is first authorized to apply the income inclusion rule, and only when the state of the parent does not apply the income inclusion rule, the state of the paying entity could actually apply the base eroding payments rule or the reverse CFC. On the other hand, there are, apart from the main rules, there are some supporting rules, and one of them is the switchover rule. Now, the switchover rule essentially deals with the situation when there's a tax treaty between, in our example, country A and country B, and the enterprise in country A is operating with a permanent establishment or a branch in country B, and in the tax treaty, there is a mechanism which essentially says, or which essentially exempts the profit paid by the PE from taxes in country A. So in Article 23A of the OECD model, you have the exemption method. So if the exemption method applies to this case, and if the PE is situated in a low tax jurisdiction. So in this case, the idea is to switch over from the exemption method to a credit method. Now, which countries follow this kind of rule is that, Germany in its in the past it used to follow the exemption method, and Germany many treaties which Germany has entered into other countries, it has the exemption method, but Germany then introduced a unilateral switchover clause in its national law to combat German enterprises from setting up low tax PEs in other countries. So there was a unilateral switchover clause that was introduced. But I'm not really clear at this stage whether this switchover clause will be introduced at the level of the treaty or at the level of national law. I'm assuming it's at the level of the treaty, because if it's introduced at the level of national law, especially in some monistic states, there could be conflicts with tax treaties. And on the other hand, there's another supporting rule, but mostly applicable from the state from where the payment is being made, is that a subject to tax rule would be included in the tax treaty. Now, once again, it's not really clear whether the subject to tax rule would apply to only passive income streams, such as dividends, interest, royalties found in Article 10, 11, 12 of the OECD model, or would it apply, or the UN model, or it would apply to on a more broader basis on all kinds of income that the entity derives. So this is a rule that is being contemplated at the level of the treaty. So in my opinion, the switchover clause, subject to tax clauses, are rules that will be plugged into tax treaties. And with this, I hand over the panel discussion back to you, Professor Danon.
Thank you very much, Professor Chan. Perhaps just to open the discussion, Guglielmo, let me give you the floor first for your insights on the Pillar 2 proposal. Please, Guglielmo.
Thank you very much, Robert. Well, I wish to make a few comments on Vikram's presentation. Some general comments first, and then I shall express my view on some of the technical points. I find Pillar 2 very confusing. Very confusing because I don't find a consistency, a systematic approach in the entire framework of Pillar 2. So even more confusing compared to Pillar 1 on the consumer-facing part, at least. Just two examples and some issues. One example is why should conceptually the rule under Pillar 2 apply only to M&E having a turnover greater than a certain amount? The rules are the rules. If we look at unfair tax competition and a race to the bottom, which is something that the European Union has experienced to a very large extent, there is no reason to differentiate on the basis of the size. So that I would have difficulty to justify such a distinction. Second, the basis for determining the effective rate based on the consolidated financial statement, I believe that would not work easily. All countries having CFC rules have departed from financial statements for the difficulties that we have on the difference between the commercial balance sheet and the tax balance sheet. Obviously, we should not underassess the issues regarding interaction between Pillar 2 and regional rules. By regional rules, I make reference, for instance, to the European Union rules on unfair tax competition and state aids. So I can visualize issues regarding the interaction between the Pillar 2 and the EU state aid principles, which might have difficulty to coexist in a consistency manner. Another point which is stimulated by Bikram's presentation, which I'd like to address, is precisely the one slide that he mentioned on the switchover rule, which basically I can consider only to the extent that it is a domestic rule, because in many countries to switch from exemption to a credit, so to have a situation whereby the treaty rule is worse compared to the domestic rule, is permitted only to the extent that the treaty makes sure that you are consistent with the domestic law in terms of anti-abuse. So I find it difficult to have a switchover rule which is not embedded in domestic law. Now, very shortly on some technical points regarding the proposal. Should the proposal go forward, I would be more in favor for a country-by-country approach rather than a global blending. In terms of policy, I believe that the global blending would basically favor financing by high tax jurisdictions to low tax jurisdiction, because you could use the greater amount of taxes levied in high tax jurisdiction to basically permit low tax jurisdiction to continue applying low tax on corporate profits. So if you really want to achieve a good, fair competition, then country by country is more complicated, but certainly better than global blending. I believe that in the history of international taxation, we have some similar discussion under the foreign tax credit rules, when countries, credit countries introduced tax credit, foreign tax credit rules. They had to decide on per country limitations versus overall limitation. And one of the issues was precisely that the overall limitation could permit some tax arbitrage, and that was basically the reason for choosing the other methodology. A final point I wish to address has to do with the special tax regimes, including the COVID tax regimes, which may create issues and have Pillar 2 apply when the intention was not to have certain tax incentives to disappear. For instance, if we look at patent box regimes, they are not unfair tax regimes. They are recognized in all countries in which they have been introduced as being healthy tax incentives, and therefore they should not be killed by a Pillar 2 system. The same seems to apply to the notional interest deduction, which the OECD itself indicated not to be comparable or to be included in hybrid mismatches under the multilateral instrument discussion and the BEPS discussion. Another measure and another example, and I now turn to the COVID measures. Think of the carryback of losses. I understand that the U.S. Is one of the measures which the U.S. included in the COVID measures. I don't know whether you had that in the past, namely the carryback for losses, but countries which, for instance, because of COVID or for other reasons, were to introduce a carryback of losses, they could basically be triggered today by CFC rules in other jurisdictions and tomorrow by Pillar 2. And I would find the carryback of losses to be a healthy and fair rule, and therefore it should not be killed or considered under the Pillar 2 system. So I believe that should Pillar 2 go forward, there will be a need to establish principles which permit tax incentives to continue to operate, and more or less the technique could be the one which in a different context is adopted by the US Model Convention, which defines special tax regimes in the Model Treaty and excludes from the special tax regimes specifically certain tax incentives which are granted to either individuals or corporations in the context of corporation tax. And that I think should be done also in the context of Pillar 2 in order not to eliminate tax incentives which are very helpful for the economy and for certain industries. Thank you.
Thank you very much, Guglielmo. As always, your intervention is extremely rich and filled with a lot of key issues. I think one point that you are mentioning, of course, to some extent, indirectly, is the consistency between Pillar 2 and what we call the BEPS 1 agenda, and in particular, the consistency between Pillar 2 and the Action 5 approved regime, typically those patent box regime that comply with the modified nexus approach. Now, I think here the debate is really relevant, because the question is, what do we mean by tax competition? Let me read out to you a statement that is directly extracted from BEPS, the BEPS Action 5 final reports. This is paragraph 3. It says, the work on harmful tax practices is not intended to promote the harmonization of income taxes or tax structures generally within or outside the OECD, nor is it about dictating to any country which should be the appropriate level of tax rates. Rather, the work is about reducing the distortionary influence of taxation on the location of mobile, financial, and service activities. The concept of tax competition has evolved undoubtedly between Pillar 1 and the BEPS, between Pillar 2, and the BEPS Point 1 initiative. If we were consistent, indeed, we would need to exclude from and carve out from the discussion those regimes that comply with substance-based requirements, such as the modified nexus approach. But it seems to me that the discussion has evolved around a new definition of tax competition, which is not entirely consistent with the notion of tax competition under the prior BEPS initiative. And I indeed pick up your comment, Guglielmo, on the special regimes which have been included in the US model, but are also suggested by the 2017 OECD commentary. And here, the issue is that the state of source should not be able to deny treaty benefits where the royalty payment, for example, is paid to a regime that is compliant from the perspective of BEPS Action 5. Now, all of this, of course, is revisited with the Pillar 2 proposal, and I would say is exacerbated in the framework of COVID-19, because if you read Pillar 2 literally, you could reach the conclusion that it could indeed strike down or affect these incentives, such as the effect produced by carryback of losses, which were introduced in a number of countries recently in the framework of COVID-19. So here there is a tension. There is a double tension with the current framework, and there is a tension between the notion of tax competition in the framework of the BEPS.1 initiative, which was about substance killing artificial structures lacking substance, versus going after tax rates. Now, I want to take a different perspective, a more technical one, and I'd like to give the floor again to Luis regarding the interaction with tax treaties. Assuming we do not have any specific reservations or modifications in tax treaties, to what extent the income inclusion rules and the base eroding payments are consistent with tax treaties. And here, just as a background, we have somehow a precedent, which of course is CFC legislation. But the compatibility of CFC legislation took years to be established. And it is only at least in the 2003 commentary that some statement clearly emerged, and then it was reaffirmed by the introduction of a savings clause in the 2017 OECD commentary and OECD model and UN model. So the question then is, was a long journey. And the question is whether this Pillar 2 proposal, both from an income inclusion perspective and a base eroding perspective, is compatible with tax treaties. And I think, Luis, you have some thoughts there.
I think that both of us, Robert and myself, we both do not know why people insist in saying that tax treaties are there only for juridical double taxation. When you read the text of the treaties, you see several articles which go much beyond the juridical double taxation, and this is the case of Article 7. Yes, you're right. In the CFC, presently there seems to be some acceptance that despite Article 7, CFC legislation could be applied. However, when you go from a technical perspective deep on Article 7, you can see that this is not a clear way. Schneider Electric was a decision against, saying that Article 7 would not allow CFC, but from then on, you had an acceptance. But from it now getting this more technical, since, as you said, we have a long path now for these new measures, whether or not this income inclusion rule would be compatible with the tax treaties. First of all, we should consider that you have in Article 7 business profit, but you have no definition of business profit. And one could claim, well, apply Article 3.2, apply the national definition, which could be used, so the profits of the subsidiary could be defined as profits of the parent according to its national legislation, and thus there would be no violation of Article 7. This is not very easy to accept, because Article 3.2 also says, unless the context otherwise requires. And when you get Article 7, it is clear that the context of the treaty is the separate entity approach. So you should consider profits of one company and profits of other company as belonging to different entities. This is the context of the treaty. Moreover,
Moreover, what I've been claiming is that Article 7 does not say companies are only taxable in their residence. This is not a subjective approach, at least on the reading of Article 7. You read companies are only taxable. You see profits are only taxable. That means this is an objective protection. Profits are only taxable in one country, which means that the other country is not allowed to reach these profits. Or you will say, come on, we're talking about different taxpayers. But I insist, there is no word in Article 7 referring to the taxpayers. It says the profits are not taxable. So irrespective of who is the taxpayer, the profits are only taxable in one country and not in the other country. This is the reading I have there. You'll say, well, but the commentaries say something different since 2003. Yes, these are commentaries, but these are not treaties. I insist, in the wording of the treaty, you have nothing saying that only juridical taxation would be avoided. On the contrary, and when you get Article 7, you see this objective protection. We will say, well, but come on, consider, Louis. Consider that most countries are accepting CFC legislation that it would not be against the treaty. But this is not because of the wording of the treaty, but much more because of this anti-evasion, anti-avoidance perspective you have in CFC legislation, this anti-abuse character. But in the present case of the income inclusion, you cannot talk about abuse, at least no abuse by the taxpayer. So all the arguments based on abuse would not be applicable in this case. Moreover, as you already have mentioned, and also Professor Maisto, assuming that you get incentives compliant with with BEPS Section 5, how can you talk about abuse? So I don't see any possibility of compatibility between this income inclusion proposal and the present wording of tax treaties. Of course, we may change the treaties, but this would be a different solution. Going further on Pillar 2, you have these base eroding payment rules, and which all again do not seem very compatible with tax treaties. At least if you consider that most of the payments could come under Articles 10 to 12 and even Article 7. This would be limitation for any source taxation. So I don't see a way of overruling Article 10 and 12 and Article 7. I see this as limitations for any withholding, of course, depending on the concrete treaty. And when you talk about the deduction barrier, which is the other side, I can see a problem, a denial of deduction, which could be regarded as adjustment of profits, which would not be in line with arm's length. So up to arm's length, you may have a deduction barrier, but this does not seem to be the wording and the spirit of Pillar 2. And moreover, I would claim that Article 24(4), non-discrimination, provides for the interest, royalties, and other disbursements paid by the enterprise of a contracting state to a resident of the other contracting state shall, for the purpose of determining the taxable profits of such enterprise, shall be deductible under the same condition as if they had been paid to a resident in the first mentioned state. So unless this is undeductible to a resident, I can see no possibility under the treaty because of Article 24(4) of bringing this deduction barrier. So what is the solution? I can see changing treaties once again. Maybe this will happen. Maybe against the whole MLI discussion. Or what I can foresee is that countries are going to practice treaty override, which of course would not be the best solution, but this is the most likely future. If countries were to limit the deduction to payments abroad, this would be overriding what is in the treaty. Thank you, Robert, once again for the invitation you brought me and for this inspiring question.
Thank you very much, Luis. Now, hearing you, I'm definitely in Rio in 2017. Just to summarize what you're saying treaties do not apply to persons, they apply to income. You're saying that the case of taxing your own resident through CFC legislation is a particular case, but cannot be replicated to Pillar 2 inclusion rules, at least from the perspective of an interpretation, a purposive interpretation of Article 7. And you also see a friction with the base eroding payment and 24.4. And now with that, I would like to turn to Jonathan from an EU law perspective. What are your thoughts?
Well, there is certainly a read across to EU law from the tax treaty provisions. And if we start with the proposed income inclusion rule, I think we've already seen that this is really, in substance, a CFC rule dressed up in new clothing. And so in substance, it's probably treated the same way under EU law as CFCs. And that means that in principle, it infringes the right of establishment, and it also infringes the free movement of capital, which means that it would apply to subsidiaries or PEs both in and outside the EU. The only defense which is recognized is to prevent avoidance or abuse, and that has got to be judged on a case-by-case basis. So, in general, while you could have an income inclusion rule, it would have to operate by reference to abuse, again determined case by case. As far as base eroding payments are concerned, again, there is a similar issue in terms of compatibility on the right of establishment, on the free movement of capital, and on the provision of services cross-border. Now, what is interesting here is that the Court of Justice said a number of years ago in a case ICI versus Colmer that base erosion itself is not a justification for a restriction on the fundamental freedoms. And unless that position is going to change, the mere fact that there is a reduction in tax will not justify an infringement. Now, the one possible exception, which again is quite similar to what we see in Article 24 of the model treaties, and that is where the arm's length principle is engaged, then the Court of Justice has more recently said that transfer pricing rules are consistent with the fundamental freedoms where they can be justified on the basis of preventing abuse. So we've seen this recently in relation to the German CFC rules. Belgian CFC rules have been upheld by the Court of Justice. So really quite a mixed position, but certainly the ability to test these provisions under EU law.
Thank you very much, Jonathan. I think from Jonathan's comments and Louis' comments, we see that the project is not bulletproof from a certainty perspective and from a judicial review perspective. I'd like to turn now to Peter Bullizauer for a perspective on switchover clause. I think Peter is the right person to discuss this because he comes from Switzerland. Switzerland, as a background, has an exemption system, and interestingly enough, an unconditional exemption system in the sense that we don't have any switchover clause where we switch from exemption to credit with respect, for example, to profit attributable to permanent establishments abroad. And this is a difference that we have with respect to other exemption countries. Nevertheless, our Supreme Court, in a judgment, has de facto has a tendency to read a switchover clause or to look at the absence of taxation as a factor to decide on whether the exemption should be granted to a foreign branch, typically in an offshore jurisdiction. And then, of course, this policy emerged with this case law, which is, in my opinion, debatable in light of the reading of the law, but that's another question. But from that perspective, and from the perspective that Switzerland is an exemption country, Peter, what's your perspective on switchover clauses?
Okay, just quickly, basically from a pure legal perspective, I truly believe just to have a switchover clause in the double tax treaty or in the multilateral convention will not be sufficient to have it applicable also from in Switzerland. We, as Switzerland, is so since decades, we always have applied the exemption method, the unconditional exemption method. Switzerland, as a small jurisdiction, as an exported-oriented jurisdiction, I believe we even need the exemption method. And therefore, this would really work if we really wanted that we also have the unilateral basis on that. And here, just referring what you said before to our court decisions where we had offshore permanent establishments, where the Swiss court, at the end of the day, in some specific cases, argued that this PE, they saw it's basically there are activities outside Switzerland in the offshore jurisdiction, but they assumed that minded management of these companies in Switzerland. So that was a way on how they could tackle taxation into Switzerland. Or the other case where we had a real PE, where it was not a subsidiary, but where it was a real PE, where they said finally, when we have an outbound PE, then we have to look at it in a different perspective as if we have an inbound PE, which in my view was somehow a little bit problematic, to be honest. And that's a tendency where we see, yes, they want to get something like a switch over, but for me, it needs to have a clear legal basis in the Swiss legislation. Just 2-3 words finally, and then I close in the sake of time. Should the subject to tax clause be applicable to any specific items of income or more broadly? Basically, for me, this is somehow a political question on one hand side. And it depends a little bit what do we mean with Pillar 2. Do we really want to achieve a minimal taxation to applied all over the globe, basically? A real minimal taxation, 12.5%, then this would basically mean that we would look at it from a quite broad perspective. On the other hand side, when I look at BEPS on the latest developments, when I see that we also have substance-based discussions, when I look at R&D, for example, where we have the DEMPE concepts now being implemented by BEPS, I believe if there is really operational income, so we have to distinguish between real operational income, where we basically don't have benefits like distribution income, production income, and there I would say with the real operating income, which are not movable, I would not see a reason why we should really apply a switch-over clause. Wherever, when we take interest and royalties and compare it to dividends, dividends is just profit repatriation, interest income or interest expense, royalty expense, this is somehow a little bit profit shifting. And if we talk about switch over, then yes, one could think about that we apply it only for these kind of functions which are which are mobile, but for those which are really local, I would not see a reason to do so. And then finally, with the dividends, which are even not profit shifting, just profit distribution, there is not an expense in the source jurisdiction, and usually dividends anyhow allocated to the head office. I would even not see a reason why we should apply such a switchover clause. But here, I think at the end of the day, to close down, it's really a political discussion how far we really want to have a minimal taxation to be applied all over the globe. Thank you.
Thank you much, Peter. That was very clear. For closing remarks, I'd like now to turn to Mukesh, perhaps on two thoughts. And this is the two issues, actually. One is the coordination between the income inclusion rule and the base eroding rule. And more broadly, another issue that we didn't touch upon is the coordination between Pillar 2 and existing domestic CFC legislation, which are, of course, widely applied, not in Switzerland, but by many countries. How will this be coordinated, both within Pillar 2 and between Pillar 2 and existing CFC legislation? So, Mukesh, the floor is yours.
Thank you, Roberto. I must candidly confess that besides the fact that I'm not a fan of Pillar 2 Globe proposals, I haven't even studied the Pillar 2 proposals in detail, primarily because we do not have an equivalent of the CFC law as you have in Switzerland. I think that the policy prescriptions for tax administrations, particularly the emerging markets, are going to be broadly in two categories. But before I get to policy prescription, I just wanted to take one more question that came on Pillar 1, possibly from an emerging market, and I was planning to sum up using that. The question is that, is it too late for seeking a solution for amount A within the arm's length principle, for instance, application of profit split method with value chain analysis for determining an arm's length remuneration for customer and user contribution? Well, the theoretical answer to that question is yes, you could, and perhaps it is not too late for a solution under, under amount A, or rather under Pillar 1 for amount A. However, the complexity of the issue is how do you go about determining beyond amount A? In my view, for emerging markets, particularly for India, a mixed approach, which is the use of the modified profit split approach, is the way forward. Now, when you use the modified profit split approach, besides determining the regular returns on routine functions, and I didn't want to get into this debate of routine versus non-routine and what should be an arm's length return for a routine function, the complex issue for countries such as India would be the determination of the non-routine profit. And the non-routine profit, simplistically stated, would be the net global profit less the routine profit, as Vikram laid out in his slide, which in my view has to be split between the trade and the marketing intangibles. The complexity for applying the revised profit split method is the quantification of the non-routine profits, and how do you go about allocating the market and user jurisdictions based on marketing intangibles or user participation. That is where an element of subjectivity tends to set in. I think the easiest way, in my view, to address this issue is a criteria-based definition and objective scope for non-routine profitable portable profits, which is also envisioned in the digital P concept in Action Point 1 report. Thereafter, a realistic market return has to be determined based on the arm's length principle, which may be allocated to the non-routine functions based on trade intangibles, and the remaining profits can be divided between the market jurisdictions based on allocation keys, whether they are for sales or user participation, which should truly reflect the realities of the taxpayer's facts and circumstances. Now, this may sound like very, very prescriptive, leaving many questions open, particularly for countries such as India and many emerging markets, which look at the interpretation law based more on principle-based interpretation rather than rule-based interpretation, as you see in many parts of European Union. So I think it's going to be a challenge of sorts if a global consensus does not emerge, because that would mean that this exercise is not going to be easy. It's bound to result in double taxation. It is too unrealistic at this point in time to think that countries should withdraw all unilateral measures, because we all know that these measures are serving as an interim quick fix solutions, and these are not long-term solution processes at all. This will, in my view, force countries to strengthen the MAP resolution process and create lots of works for lawyers who will get typically involved in disputes should a credible MAP process or dispute resolution process arise in the future. So I'm sorry, Roberto, if I'm ending on this somber note, or rather not sounding positive about it, but listening to all the speakers, I just felt that I should conclude it with those questions in mind. And maybe the stance was more for India and emerging markets, but these questions are bound to arise in many, many jurisdictions I can think of.
Thank you very much.